Hello and welcome everyone to my channel, The Quality Investor. Today we are discussing software giant Adobe. Adobe is a global leader in the digital design and creative space with a mega cap of $272.8 billion. They have been on a torrid run in 2023, returning 78% year to date, putting them in the 96th percentile of largest year-to-date returns of S&P 500 businesses. They just closed out their 2023 fiscal year with a record $19.4 billion in revenue, a 10% year-over-year increase. Their diluted earnings per share grew 17% to $11.82. One of my heat check items in earnings releases is margins. Adobe's gross margin remained flat year over year at 88%, which is great, of course, and their operating margin expanded by 100 bips to 34.3%, demonstrating and reinforcing their market dominant position. However, since they released their earnings last week, they have lost 5.5% since their 52-week high of $633.66. In light of Adobe's earnings, I want to assess Adobe's business model and see if the slight market pullback makes Adobe a stock to buy now. So, before diving into Adobe's business model, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. Adobe provides value to many of the creative customer segments through image, video, and content enhancement and creation software. Their software is synonymous with photo editing. To Photoshop is even a verb now. Adobe's product suite has gained such widespread usage that it is the industry standard. They target a wide range of customer segments. Adobe counts as product users, individuals, artists, students, marketing teams, and small, medium, and large businesses. An attractive prospect for any investor digging into Adobe is their subscription-based revenue model. Subscriptions are an excellent source of predictable income. They earn 94.2% of their revenue through subscriptions in the just closed fiscal year 2023. Once people subscribe to something, they are more likely than not to renew it. This makes it simpler to project forward growth while providing a steady inflow of cash. They began their transition from a priority licensing firm to the software as a service or SaaS model around 2012. They saw their revenue and earnings decline a little bit through 2013 and 2014. However, they rebounded nicely in the 2015 year, and Adobe has been a powerhouse since, returning a remarkable 26.5% annually since the end of 2013, compared to a 6.7% annual return for the 9 years before that. Adobe has a wide array of offerings focused on their core business of creativity and design. Their products are segmented by digital media and digital experience. The digital media segment is further broken down into the Creative Cloud and the Document Cloud. The Creative Cloud is Adobe's largest source of subscription revenue, accounting for approximately 60% of total revenue. This, of course, is where the most well-known desktop and web apps like Photoshop, Illustrator, Premiere Pro, and much more reside. The Document Cloud is related to all things PDF and document manipulation, with its major software, Acrobat Reader. The Digital Experience segment is geared towards businesses. It provides marketing and analytics software designed to give businesses insight into customers' behavior, create marketing content, and measure customer responsiveness. They also have a smaller publishing and advertising segment. Adobe's leadership in these software offerings has created a significant economic moat. The widest part of that moat is switching costs. Adobe software is complex and intricate. It can take users years to learn and master apps like Photoshop and Illustrator. This deep functionality and high learning curve means users are far less likely to switch to another software and start from scratch. This provides a significant advantage for Adobe since users are effectively locked in to their software once they learn. Adobe's ecosystem of software is also integrated, giving users seamless transition to other Adobe software. Additionally, Adobe has an extensive library of assets and templates, which is difficult to transfer to non-Adobe platforms. Adobe is the standard when it comes to digital creativity. This led to considerable market share for some of its products. In the design and editing software market, Adobe has a 47% share of total industry revenue according to IBIS World. They have a reputation for offering cutting-edge design software, which has led to a small network effect as their software gains value as users create their own libraries, assets, and other extensions for the software. They also invest heavily in R&D to bolster their technology and add new functionality, reinforcing their reputation. The other material part of their moat is the subscription revenue model. We already discussed that, so I will not go into detail here. But what do the numbers say? Is Adobe still overvalued despite the small market pullback? We are here on my investment summary page, and you can see right away that Adobe still trades at a very expensive valuation. Right now, their PE ratio is at 54.1, and that is way ahead of their 5-year average of 49, but behind their 10-year average of 65.7. Their forward PE ratio is at 50.8, which is still way ahead of their 5 and 10-year averages. However, when you look at their profitability, you can see Adobe has done an excellent job of increasing their margins. Both gross and operating margins are at or above their 5 and 10-year averages, and they also have an excellent return on invested capital and return on capital employed, both well ahead of their 5 and 10-year averages. This speaks very highly to that transition to a subscription-based revenue model, as it's really done wonders for Adobe's bottom line. And that subscription-based revenue model has made their charts into a thing of beauty. You can see here the excellent growth in their revenue and net income, as well as their earnings per share. They've also done an excellent job of lowering their SG&A margin while simultaneously increasing their operating margin. They also have an incredible share buyback program, buying back shares nearly every single quarter for the last 10 years. And of course, on the balance sheet side, you can see here, they've also done an excellent job of growing that cash, paying down debt, and the holy grail, increasing cash flow. Free cash flow is the lifeblood of a business, and we always want to see that trending upwards. For Adobe's growth rate projections, I am looking at revenue growing at about 10.5% annually over the next 10 years, based on what Adobe has said, as well as analysts for Adobe, and their operating income to grow at nearly 11% over the next 10 years. That is based on them expanding their margin 36% for operating margin. I am also projecting their earnings per share to grow at 12.8% and free cash flow to grow to 11.16% on an annual basis the next 10 years. That's if they can convert $1.52 of every $1 of net income into free cash. That would lead to a free cash flow margin expansion of about 0.5% a year. And you can see that's more conservative than what they've done in the last 10 years. Same with their free cash flow growth rate. They've grown their free cash at 20% for the last 10 years. With any growth rate projections, my goal is to be realistic but conservative. And I think I'm doing that with my next 10-year growth rates being a little bit lower than what they've done historically over the last 10 years. So coming over to my discounted cash flow model, after I drop in those numbers from the growth rates and discount my free cash flow back at 8% per year with a 3% exit multiple, we get a discounted cash flow price of $634.14. As for the exit multiples model, I have chosen as Adobe's peers Microsoft, Oracle, Synopsys, and Salesforce. And once we average out their PEs, we get an average PE there of 58.1, which gives us an exit multiples price of $645.49. So how do all these numbers affect our valuation? Well, like I said before, they have a discounted cash flow of $634.14 and an exit multiple of $645.49. They do not pay a dividend, so we will not include that here. They currently are trading at $602.10, which will have a valuation average of $638.11, which is a potential upside of about 6%. I'm giving myself a 15% margin of safety due to the high volatility of their price movements, and I don't think it's unreasonable to see Adobe have a little bit more of a pullback, coming down to our acceptable buy price of $542.40. That would mean The desired PE here is about 48.8 or right around their 5-year average. You can see here on the returns that Adobe is a powerhouse of a return business. However, they are a volatile business, and you can see over the last 3 years and even over the last 5 years that there are ample opportunities for pullbacks given that volatility. So for right now, I think the market has priced Adobe pretty fairly. It is certainly pretty expensive given their 54.2 PE ratio. However, they're certainly not at a discount right now. And for me, I will wait until the price comes down a little bit more to put a large sum of money into Adobe. Adobe is a strong business with a wide economic moat and will provide solid growth for many more years. Before we go, I do want to remind you that this is not financial advice and I do not own any stake in Adobe. With that, thank you for watching today's video. And what do you think? Is this a fair valuation? Please let me know in the comments below. And lastly, please hit that like button. And if you found this info helpful, subscribe to the channel to join our community. Thank you and happy investing.